The crisis that happened to China is the kind of crisis that would have brought other countries down, but China didn't collapse. And nobody really knows just how much cash or gold China actually has stashed away as ammunition. Chinese stocks are starting to bounce back now. So what's next? Because, hey, Chinese stocks, man, they've been dropping for three years in a row. Anyone who bought back then at peak prices has been stuck for ages. Now that stocks are finally picking up, it's just a tiny, stagnant bump. So what now? What should we do next? So in this video, let's start with a bit of Chinese history. How did China get to where it is now? And is it really a country we can trust? Is it worth sticking with? Another part is the technical side. Let's check out the charts. See how it moves up like this, then like so, and what's next? Let's keep it simple. First, let's listen to some Chinese history. China's a country that's always been very independent, right? They grew on their own, kind of like someone who's made it by themselves. Like, I did it all myself. I don't need anyone. Recently, news broke that Ukraine asked China to help negotiate a ceasefire with Russia. Do you know how China responded? They said, that's not our business. If you want peace, talk it out yourselves. China straight up said, now's not the time. Even if they'd speak for Ukraine, they just wouldn't. I'll share more on that later, but first, China used to be one of the 10 poorest countries in the world. Seriously, one of the poorest. It was really rough. People under the communist regime back then had nothing to eat. My dad said that our ancestors came from Shantou, and what they ate was basically digging up taro and cassava to survive. Whatever crops they managed to grow, they had to send off to the government. They had nothing of their own. Even the cassava roots weren't really theirs. They belonged to the government, which collected everything. The government would then redistribute it. The clothes everyone wore were all gray, just plain gray. Everyone looked the same. They wouldn't even allow any kind of to invest in the country. The government controlled everything, managed, regulated, and shut things down until Deng Xiaoping came to power. When he became president, he decided, all right, let's open up the country and let investors come in. So after that, China started allowing foreign investment. Developed really quickly. Everyone knows China as the place where you can buy anything from China at any price, right? They're basically the factory of the world. They manufacture everything. They produce everything for people to use, to the point that if you look at the trade balances of the world's major countries right now, you'll see that China is pretty much the only country that consistently runs a trade surplus with other countries, and it's been increasing and steadily growing. As for America, don't even mention it. They've been running a trade deficit for ages, for decades. Thailand is the same way. Then China started to enter an era where it would transform its society from a class of mostly poor people to a middle-class society. Let me pull up some numbers real quick before I forget. In China, they have a population of over 1 billion people, right? They shifted their population. The middle class went from just 3.1% to 50% of the country, or about 850 million people. So it became an enormous purchasing power for the entire world. Every single nation has come to rely on China. And then China began to shift away from a rural society to an urban one, right? So people had to migrate from the countryside into the cities. And once they got to the cities, they worked in industries and started earning higher salaries. But what people who migrated from other provinces or region didn't get in the big provinces was welfare. No education benefits, no health care, or any kind of welfare, or basic rights that people should have. They didn't receive the same benefits as the locals in that province. So basically, they're second-class citizens. One way to become a citizen of that province and get the same welfare as the locals, to become a first-class citizen, is to buy a house. But actually, in China, they don't really let you buy a house. It's called leasing land for a long term. So people have to work really hard to save up enough money to buy a house. It all starts with buying a house because they want the right to live there, the right to freedom, that province. And then it turned out that people started buying more and more. The government saw this and thought, hey, once people started pouring money into buying houses, the government also benefited because it earned revenue from people coming to lease land long term or buy houses in the province. In this province, the government then encouraged people to come and buy houses. So real estate became a bigger and bigger business. China's real estate industry started to grow from that point on. Then, at that time, there were only 4 main banks in China. And China was very strict with the banks. The main banks were strict about lending money, right? Because of this strictness, shadow banks emerged. Because when the number of people who wanted houses increased a lot, it became impossible to borrow enough from those four main banks. The money just wasn't enough, and the government wouldn't allow more lending either. So people had to borrow from shadow banks. That's why shadow banks became a major source of loans for China's real estate sector. But shadow banks don't take deposits like regular banks do. They offer other investment products. And during the real estate boom, those shadow banks that were the main lenders, they earned returns in the form of interest, right? The more they higher interest returns meant more loans, and it got easier. This cycle continued until a real estate bubble formed. First, there was Evergrande. It looked ready to collapse, teetering for years now. The value of Evergrande is about 300 billion US dollars. In the end, it finally collapsed last year, right? After that, Country Garden, which is 4 times bigger than Evergrande, 4 times bigger, also collapsed because it had become a real estate bubble. There was even a point during the 2008 global crisis, the subprime crisis, the hamburger crisis. At that time, every country was hit by the crisis except China. China wasn't affected because they issued massive loans. I can't remember the exact numbers because back then China still believed that they would be able to handle that huge amount of loans. So they went ahead and released that massive loan package, which these days, that huge loan package, it ended up running into the COVID crisis, right? So it just became kind of stuck in limbo. They call it the local government debt crisis, which still can't be solved right now. So China is facing a real estate bubble, a local government debt crisis, and shadow banks. Whenever something collapses, the first question we should ask as investors is, who lent money to this industry? Shadow banks. On November 23rd last year, Zhangji, the biggest shadow bank, the biggest one in China, collapsed. If the number one collapses, then number 2, 3, and 4, yeah, they're likely to follow. And stocks, well, and the loans that are coming due in China this year amount to hundreds of billions of US dollars, especially from the shadow banking sector. Now, let's continue with the question. Since Chinese stocks are starting to pick up, what should we do, Prasai? What should we do? I still think that China is a country with massive potential. No one can really say for sure whether they have it or not. Now, China is buying up gold straight into their reserves like crazy, whether it's gold purchased through official channels or underground gold. Russia is happy because China buys its gold. Let's take a look at the reasons why exactly Chinese stocks have been dropping so significantly. Is it the stocks themselves or the global crisis? They've been dropping for 3 years, right? Let the graph tell the story. The CSI 300 is an index of the top 300 stocks in China. Looking back 5 years, it's divided into 2 cycles. The first is the upward trend from January. From 2019 until February 2021, the index reached its highest point. The CSI 300 peaked at 5,800, then shifted like night and day because the stocks crashed. At that time, when it was going up, everyone wanted to buy. Investment money was pouring in and every investor wanted to get in. It just kept climbing to the very top until the downturn hit in the last year of this cycle. From February 2021 up until now, it's been hovering just above 3,000, which is the lowest point in the past 5 years. Zooming in even closer, over the past 12 months, the graph has been dropping at a sharp 45-degree angle. That means it's been consistently falling over the last 12 months due to the real estate bubble crisis. Actually, if it wasn't China, even in America, the real estate bubble has already burst. You might ask, is it because of the global economy? Well, compare it to the S&P 500 in the US. Over the past 12 months, the S&P 500 stocks are up 25%, but that's mainly because of tech stocks. It's really the tech sector that's driven the growth, not the whole market. Not all of it. Luckily, America has tech stocks. Now, if you ask about China, how much potential do they have to manipulate their own capital markets? Let's take a look at this. They actually do it. They manipulate the market, and they do it a lot. Over the past 6 months, if you look at the timeline of the CSI 300, when Chinese stocks took a nosedive, right here on August 18th, the Chinese government announced a plan to revive the stock market. 10 days later, on August 28th, China announced a reduction in stock trading taxes and fees, cutting them by 50% to encourage more people to buy stocks. Then, on September 1st, they announced stricter inspections, covering every single activity related to stock purchases, meaning they wouldn't let anything slip out that could lead to news causing the stock market to be shaken up at all. So, did these three actions work? They basically jolted the corpse, meaning the stocks jumped up a bit and then dropped again. On October 23rd, the government announced it would use the national budget to buy ETF funds. They probably bought a significant amount because the corpse jolted again. Then, on October 30th, the government rolled out a policy for big companies to buy back their own shares to try to boost stock prices. Then, on November 27th, the government ordered that anyone holding a large amount of shares, anyone with a lot of shares, was strictly forbidden from selling them. I couldn't sell my stocks because the government banned it. This action didn't help at all. The stocks kept falling. On January 22nd, the government announced it would inject funds into the system for both the medium and long term. Injecting funds basically means printing money. Then, on January 24th, the government announced it would inject another 1 trillion yuan and also ordered a reduction in the reserve requirement ratio for the banks as well. Normally, banks are required to maintain a certain reserve ratio, a pretty high one, right? But if the reserve requirement for banks is lowered, there could be some more risk, but banks would be able to lend more. If they can lend more, more money will flow into the system. All of these measures are pretty strong, but if we're talking about the strongest measure, the one that really shakes up the entire structure of China's business system, it's when this past January, China announced a cut in interest rates. To help solve what problem? To solve the real estate bubble issue in rural areas, where people are just dumping their properties, right? People just don't want them anymore, right? But if they actually cut interest rates, then people will be able to pay off their mortgages. This is a structural solution to the entire problem. So I want you to look at this. When we want to see whether a market is healthy or not, we have to check if money is flowing in or not. So let's look at the capital inflow into China. If you want to assess the health of the financial and business sectors, you should check how much money is coming in. Here, I brought this for you to see. This is an overview of the stock market, the capital and financial markets inflow into China in 2021, when the stock index hit an all-time high at 5,800 points. At that time, a total of 29 billion US dollars flowed into China's capital market. But when the stocks dropped in the second year, in 2022, the capital inflow into China decreased a lot, by half. It was only 13.9 billion US dollars. And then in 2023, the capital inflow into China's capital market was only 1.54 billion US dollars. This is the capital flows into the capital market, meaning it goes into the stock market. And as for FDI, or foreign direct investment, which is the money that is invested directly in China, that also has dropped as well. In 2021, the capital invested in China was 350 billion US dollars, an enormous amount. But in 2022, it dropped by half. Then in 2023, when the stock market kept going negative, the capital was negative. The capital dropped to $20 billion from $350 billion in 2021. By 2023, it hit $20 billion. Half. That's really not much at all. That's why Chinese stocks just aren't going anywhere. Foreign investors just don't want to put their money here anymore. But if you ask whether China has a secret card up its sleeve, for sure. China definitely has a secret card. I mean, stocks have dropped that much, but can you believe the yuan is still stable? How is it even stable when the market is doing that badly? At first, when the stock market first started dropping, the yuan did weaken. But after a while, it didn't weaken anymore. It stayed stable. If you look at the yuan's chart over the past 12 months, the yuan was once at 6.7 to 1 US dollar. In the first 6 months, it weakened to 7.2. That part is pretty normal. But in the yellow zone, starting from July 2023 to now, the yuan's value has been moving sideways. Why is it moving sideways? The answer is simple. They're pegging the currency. Do you know what they use to peg the currency? It's really simple. Foreign exchange reserves. They use it to peg the currency. Thailand did this too during the Tom Yum Kung crisis, but Thailand is a small country, just tiny. Pegging the currency like that would ruin you, but China doesn't collapse. And as I said, when you peg a currency, you use foreign reserves to do it, right? Want to look at China's foreign reserves graph? Check it out. It hit the floor in 2022, but suddenly in 2023, there's this huge spike. Where did all those foreign reserves come from? Out of nowhere, right? The stock market was dropping, but the currency stayed stable, and then these foreign reserves just appeared out of thin air, like a mystery. Bloomberg even reported that China had mysterious foreign reserves flowing into the system, 3 trillion US dollars, without any transparency. China has its own ways of controlling things. The yuan, right? Every morning during government meetings in China, they decide that the yuan is only allowed to move up or down by no more than 2%. Former President Donald Trump once said that back in 2017 and 2018, the Chinese currency was weak, right? A weak currency means you can an advantage when selling goods. A weak currency means Chinese products are cheaper without the Chinese having to do anything. Donald Trump called that an artificial low, meaning it's a fake kind of low. Let me tell you, China is a very powerful country. The crisis that happened to China is a crisis that other countries would have collapsed from this kind of crisis. But when it happened to China, China didn't collapse. And nobody really knows how much money or gold China actually has as reserves, or if they've already run out and to what extent. So in summary, China is a country you shouldn't let fall apart easily. And right now, the stocks are pretty undervalued. Personally, I'm in. I'm buying. But when it comes to investing, there are risks involved. I'm not recommending anyone to buy. If you end up stuck with losses, don't blame me. But if you want to keep up with financial stories, come check them out with me at Money Monster. Goodbye.